Hello everyone, welcome to our Egyptian online seminar group. First, keep your microphones off. Then, if you have any questions, you can ask our speaker out during his presentation or after his presentation. I have great pleasure of welcoming Professor Feng Chen. Feng is an associate professor of accounting in the Department of Management at the University of Toronto. He obtained his Ph.D. in accounting from Columbia Business School. His research interested involve auditing, corporate disclosure, corporate governance, and international accounting. His research has been published in top ranking journals in accounting, including Contemporary Accounting Research, Journal of Accounting Research, Review of Accounting Studies, and the Accounting Review. Now we will start our seminar with Professor Feng Chen.
Thank you very much, Mohammed. And it's really, as I said, it's really great pleasure to come to this global online seminar. And again, I would like to recognize the effort and contribution by Mohammed to organize and host all those online seminars in past year during the pandemic. It's a very trying time for everyone, but I think this is a really good opportunity, and a good way to disseminate knowledge and to communicate, across countries, right? Among all those, accounting and auditing and maybe finance researchers. Now, as Mohammed said a moment ago, my research area, I have a few research areas. I work on accounting, auditing, and also somehow I also work on some finance areas. So as you can see from the title here, the title is called Are There Externalities of Private Firm Disclosure? Evidence from Public Firms Investment. Okay, as you can see from the title here, I kind of try to mingle, have, the mixture of two elements, right? One accounting element, which is, disclosure is more like a typical accounting element. The other element is more like a finance element, more like an investment decision and so on, right? So I kind of mingle that the two elements together, and which I kind of reflect my research, areas, because I work on quite a few accounting areas and auditing areas, and also in somewhat of finance areas as well. All right, so this paper is a collaboration work with several researchers from China, Yiding, Feng Chen, and also Xiao Qiao from several Chinese universities. And once again, I really appreciate your comments. So please do not afraid to interrupt me. Please interrupt me actually, okay? As this paper is a really early paper, and we really appreciate your, comments, even some random thoughts from you could really, help us a lot. Okay, sorry, I somehow cannot change the page. Sorry. I hope now, okay, now it's good. Now, let me first, so we have several parts of the presentation here. So we will talk about the background information, then I move to literature, and then I move to talking about data and methodology. Finally, I talk about results and summary, okay? So this is roughly the idea of the today's presentation. In terms of background here, I want to give you because the paper is about private firm and public firms. So I need to give you some background information of private firms versus public firms. And I have to talk about some accounting financial reporting requirements for private firms in North America, but not in the US specifically, but not necessarily in Egypt or any other countries, okay? Because I know, for example, I'm going to mention that in some other countries, the financial reporting requirement could be very different, okay? So first of all, we have to recognize the importance of private firms in the whole economy. Here, private firms account for a significant portion of the economy. For example, here, there is, research study from Renaissance Capital's 2012 research study that indicate that actually almost most of the 27 million business in the US are privately held. Okay, so essentially the only a number, let's say 10,000 or 15,000 of firms, they are public, largest, firms, they are public firms. But beyond that, almost like a 27 million business, they are all privately held. Okay, so that's in terms of number. We have a vast majority of business are privately held. And Oscar et al. 2015 estimate, and I think this is more dramatic here, is that private US firms account for approximately, I'm going to use this handwriting here, 59% of sales, 49% of aggregate pre-tax profits, and 53% of aggregate non-residential fixed investments here. So it's about 50 or roughly, or a little bit more than 50% of profits, sales, investment are coming from the private firms. So we probably can use that numbers to dismiss that misperception that saying, oh, private firms not that important. They are very important. They are important in terms of numbers. They are in terms of number of private firms or number of private businesses, right? They are also important in terms of their economic power in magnitude here, right? In the sense of profits, sales, etc., right? Now, speaking of data, we use data from CapitalIQ because we look at US private firms, right? So we use the CapitalIQ database, and I'm going to talk about a little bit about CapitalIQ database here. In the CapitalIQ database, there are about 60,000 plus private firms and about 10,000 plus public firms. Okay. Now I want to tell you a little bit difference between the disclosure from the private firm and the public firms here. I have to mention, and I will get into the specific, in a moment in another slide here, but I want to mention that a lot of private firms actually, they are required to public file financial reports. For example, one kind of private firms would be the private firms they issue public debt, okay? They issue public debt, okay? So those are those private firms, they have to issue public debt, the public financial reports here, okay? Now, if you look at the SEC, US, SEC, website. Yes, go ahead.
Professor Paul can ask. Please open your mic and ask your question.
Can you hear me?
Yes. Yeah, I can. Can you hear me?
Yes, I can hear you now.
So my question is this. So private firms in the US are not required for mandatory reporting. So is there any algorithm or rule that CapitalIQ uses to decide which private firms get into their database?
Paul, this is a wonderful question. Now I have to admit that this is something our co-author team talked a few times. Let me give you our assessment here. I think all the so-called private firms from CapitalIQ database, they do file the public financial reports at least at some point of time. Okay, but I will give you the two reasons here. But let me give you two brief reasons. One is that those private firms, they have, as I said, they do need to file they have a public debt, so they are required to file, financial reports, right? Another reason, I think, big important reason is that they have some sort of size or shareholder, threshold, and if they meet that threshold, they have to file on the public reports. Okay, so I think I answered your question because you are asking me. You said, besides of private firms with the public debt, any other private firms, they do, file, financial reports. And I just told you that, there are some other, private firms, they are required to file public reports. And I think, and going back to your question directly, and I think CapitalIQ actually captured, somehow compile all those, reports, or they collect information from prospectors of those private firms. The prospectors not for the public, equity offering, but for the public debt offerings. Okay. As you can see, I think I'm not sure if I can see it's here, right? Do you guys?
Yeah.
See
The reason I asked you that question is, I've done some work that convinces me that Sageworks is a biased sample of private firms, and it's something, since there's no mandatory reporting, it's something you want to be very, very, very careful of. If you don't have a representative sample, you could get results going in any direction.
Paul, you are expert here. Wonderful, wonderful. But let me give you some idea, and probably you already know about it. So Paul just mentioned another database. Okay, let me take one step back. As I keep saying, I believe CapitalIQ took they just compiled the financial reports from Edgar, or maybe perhaps some other sources, but essentially they do require all those so-called private firms, to file public financial reports, at least at some point in time. Okay, so then they can get that financial reports there. Now, there's another financial database called the Sageworks. Okay, and this is what Paul just mentioned a moment ago. Okay, and those, the data from there are also presumably for private firms, but I believe, this is what I understand, they are really the two sets of private firms here. What CapitalIQ captures is more like a larger size, or relatively speaking, larger size private firms here. Unfortunately, I don't have the specific statistics here, but it's roughly, let me just give you an idea. I just try to steal a number from some other research studies. CapitalIQ, and I'm trying to write out, I do apologize for my handwriting here. CapitalIQ, the typical size of a private firm from CapitalIQ is about 150 million total assets, roughly around there. I think this is what I read from other papers. Sageworks is about 50 million. Okay, so one is 150, the other is 50 million. So it's like so CapitalIQ's private firm universe represent more larger size private firms, while Sageworks, they represent the smaller, not tiny private firms, but smaller private firms. And I think Paul actually complained, which I did not verify because we did not use the Sageworks data. And I probably can argue for a couple of reasons in a moment, but I think one thing what Paul complained about is that Sageworks, and they got their data from certain algorithms there. And I think there's a rumor saying that sometimes the data coming from their conjecture or expectation, or not like really like the real data and so on. I did not verify that. I haven't used that database yet. So that's another story here. Yes, go ahead.
Sageworks is not available. Sageworks is not available. You can't use it. You can't. It's not available anymore. You can't use it.
It's not available anymore?
No, but I'm just saying that since private firms are not mandated to disclose, you have to be very careful. There's some selection issue that's going on, and you just have to be very careful about that. That's all. I just want to just be aware of that.
Okay, that's a good point. That's a very good point. But I think Paul, thank you for that point. But I mean, in a moment, maybe when I present you the more data and more numbers and maybe more results, hopefully you get the concern getting hopefully is getting a little bit mitigated more or less. But you can get back to me in a moment by saying, hey, yes, you still have that concern. You still but I think we are trying to argue by selectively, this is something I can see your discomfort here, by selectively using a somewhat larger sized private firms in that kind of private universe actually works to our favor. Okay, so in a moment, hopefully I can make an assessment. Okay, make an assertion.
I don't know. Okay.
Now, Now let's get back. Thank you, Paul. Let's get back to this slide. What I'm trying to tell you is that if you just look at the 3M, I have two examples here. One is a 3M, the other is a firm called Medtronic Inc. Okay, so for 3M is like a typical public firms. The typical private public firms, and they are required to make all sorts of disclosure, including AK disclosure, 10Q, 10K, and all sorts of definitive statement, which is more like definitive process statements and so on. Okay, so also the disclosures. If you look at the right-hand side, you see, Medtronic, okay? And this is something I'm not sure, maybe Paul can teach me, or maybe we can discuss. This is something that but I'm still wondering, and I was very surprised. And actually, this morning, I was talking to my co-author, and I don't know what's going on here. And I was very surprised by seeing that if you look at the firm, this firm, and I checked yesterday, the firm in the past 3 years, and I did not see this firm, Medtronic, makes periodic financial reports. Even the firm issues the public debt, on the time. Okay, so my conjecture, and that's why I say the CapitalIQ, somehow they collect data from more like they compile data from different sources, from not necessarily from the 10K filing of a private firms, but maybe from the prospectors, because I do understand that the firm, this is Medtronic, actually issue public debt all the time, almost like every year. So by issuing public debt, the firm has to file this so-called prospectus. In the prospectus, the firm has to give past 2 or 3 years of financial reports. Okay, that could be one source, but the firm does not, and this is something I have to double check. The firm actually does not file periodic 10K, actually, as I thought the firm should do. Okay, so this is something. I have to tell you. This is a research. I don't know everything yet. Okay, but one message I want to convey to you is that yes, private firms, they are required to file some financial reports. They don't file as much information as public firms. So that's the kind of key message I want to convey to you. All right. Now I want to move to the incentive and maybe some other elements of factors affecting the disclosure between private firms and public firms here. And we want to highlight the voluntary aspect. Why? Because my paper is more like voluntary. I try to emphasize voluntary. We don't want to. We kind of stay a little bit away from the mandatory disclosure element here. Okay, so for voluntary disclosure here, you have several incentives or factors here. So for public firms, they have a shareholders, factor, for example, capital market pressure, litigation risk, could be the incentive or factors from debt holders. They do require public, financial reports, or maybe from other stakeholders. And I think the key difference from private firms and public firms is from the shareholder side, right? Because we are not saying that private firms do not have shareholders. That's wrong, okay, guys. Private firms always have almost always have shareholders, and sometimes could have a sizable shareholder list, right? But the thing here is that I think compared to typical public firms, the private firms do not, are not subject to intense capital market pressure, right? And they probably have less litigation risk, as well, right? So that's something that driving the difference between the public firm disclosure and private firm disclosure. And information made by private firms is not expected as rich as the information made by public firms. I think that's a takeaway number one, right? Not as rich. Okay, that's number one. I think number two takeaway, and this is something I'm looking at. Maybe if some of you are interested, we can work together, right? I think there is more wiggle room, right? There's more some sort of freedom, degrees of freedom among the private firm disclosure. So that's why we in a moment in almost the last part of the results, I want to show you there could be some sort of bias disclosure made by private firms, given that there's a less pressure and less litigation risk. We don't expect shareholders to file a suit, securities lawsuits against a private firm, right? It might happen, but it's not as common as we see from the public domain, right? So this is a second point. The second point is that there's a less discipline, right, in terms of filing, in terms of private firm disclosure. So there could be something more bias in there, right? Potentially, there's more bias, either conservative bias or optimistic or so-called optimism bias, right? So either side here, right? So this is, but once again, this is only a conjecture at the moment, and we still need to dig deeper there. All right. So that I hope I give you guys some more background of this, Go ahead.
Can I ask you a question?
David, yes?
Yeah.
Go ahead.
Move back one slide. The one you just talked about the rich.
Yes.
The same argument, you also can predict the opposite.
Yes.
So
why?
Because you see, if public firm has more capital pressure or litigation risk, definitely they don't want to reveal risky information.
Right.
So
yes.
it could predict.
Good point. Good point.
Okay, I just want to raise this point. Yeah. Okay, thank you.
That's a good point. That's a good point. But one thing here is, I think the argument here is that the argument, and this is something I don't have the result yet. I'm going to, but please remind David, if you don't mind, in a moment towards the end of the today's presentation, probably you can remind me, because in the cross-sectional results section, we are adding one new result. I haven't added one thing yet, but I'm going to talk about one thing. Your point is really, really good point, but I think this, I do realize that the factors, the driving factor, incentive here, I miss one key element, is that potentially, compared to typical public firms, private firms are weaker in terms of size, smaller in terms of size, weaker in terms of financial, the capability, and so on. So I think, please remind me, if you don't mind, remind me, I'm going to talk about one thing. But this is a wonderful trade-off. I 100% agree with you. The reason I think we said the private firms, typically we expect, the conventional reason is that, private, they probably won't disclose too much, right? There could be other reasons. That's what I'm saying. Okay, so I'm going to get to that in a moment. Okay, but this is a wonderful discussion. Thank you.
Thank you.
All right. Now we once again, I want to talk about some background. So what we focus here in this paper is about news disclosure, which includes both financial and non-financial information. Okay, for private firms, news. News could be financial information. I am going to give you one example from IKEA. Although that I do recognize, IKEA is not U.S. private firm. Okay, I'm sorry, but but just give you the flavor of the news disclosure. It could be both, financial and non-financial. Okay. The second one, I think we try to emphasize the voluntary. The news disclosure is really voluntary, especially for private firms. Yeah, right. And because of this voluntary information, it provides a lot of incremental information to outsiders. Why do we emphasize incremental? We are saying that as to the required, for example, the information from prospectors, right? The information from if the private firm issues 10K or 10Q, it adds to the 10K or 10Q information. Okay, and it also the news disclosure also we see that varies a lot among different private firms. And I think this somehow helps me to make the following claim, which will kind of hopefully make Paul feel a little bit better there, right? Saying that's why I think that typically the larger size the private firms, they typically make a lot of news disclosure. Okay, this is what we observe. Okay. disclose more, right? Small private, we're talking private firms, not the public firms. They disclose less. Okay. They disclose much less, and that's one reason we focus on relatively large sized private firms universe here. Okay, that's why we kind of focus on CapitalIQ, database here, and I think that's at least one good reasoning for there. Okay, because it really varies a lot, and we barely see any much news disclosure from smaller private firms. Okay, so this is IKEA. I know that it's not a U.S. firm, U.S. private firm, but it is a private firm, but it's not U.S. firm. It says, okay, so, but just to give you a flavor here, it says, IKEA U.S. reports steady performance and accelerated the transformation in 2020, even during the pandemic, and in transforming the business operation. So this is more like a news disclosure is there's not much financial really there, right? But talks about the prospect of the firm. It talks about the strategy they implemented during the pandemic, right, and so on, right. And same thing here, IKEA in China, they also do something about the accessible digitalization and so on. So two crucial parts. So once again, the strategy here, right? The keyword strategy there, right? So as you can see, that a lot of news disclosures even from private firms, the same as public firms, they reveal their performance, which is financial as element. But they also reveal their strategies, outlook, and and maybe the industry prospect as well, right? So that's kind of, I just give you a favor of the news disclosure from private firms. Okay, now a little bit more information here. I want to give you saying, hey, you may have a question, and this is, as I keep saying, that this is why we get motivated to start this research, right? And the conventional wisdom is that, as David probably said, David actually said that the other way around, but the conventional wisdom may say, well, maybe private firms may not have a much disclosure, right? And in many cases, it's true. As I said, small private firms, they don't disclose at all. They make very, very little disclosure, okay? But in fact, as taken as a whole, private firms actually make fairly significant amount of disclosure. And so that's why I just want to give you a sense here, right? So we actually listed the highest proportion of private firm news disclosure across industries, okay? So for example, what do we mean by across industry? For example, here we have number 52%, a little bit more than 52%, 53% here from so-called membership organization, this SIC two-digit code here, okay? So membership organizations, private firms taken as a whole, okay, made around 53% of a news disclosure, okay, in that industry. And so this is 53%, which means that public firms only make 47%, less than 50% of news disclosure. This is somewhat surprising, right? So it sounds that in some industries, private firms actually overtake public firms in terms of making the news disclosure. And let's look at the lowest number in that top 10 here, probably top 10 here, 22%, okay? So communication industry, private firms make about 22% of news disclosure compared to public firms who make around 78% of news disclosure. I think this is not surprising at all, right? But still the magnitude is actually fairly significant, right? Even 22% is still significant. And you may ask me saying, hey, Feng, what about the general picture here? What about the average news disclosure percentage, for private firms in any specific industry? Okay, in general, private firms, I'm once again taking whole. We are not talking about one specific private firm. We're talking about the private firms in that industry, okay? How many news disclosure we tabulate, news disclosure, right? In that industry, we tabulate news disclosure by private firms and news disclosure by public firms, and we compare the numbers, right? And so in general, I think it's about roughly about typical picture would be 10 to 15, more like a 13 to 14%, which is fairly significant. We are saying that private firms in general make 13 to 14% of news disclosure in a typical industry. Yes, go ahead, Mohammed.
Question from Paul, you can ask?
Yes. So, Feng, just another quick question. So you're dealing here with voluntary disclosures, news releases, things of that nature. What about, I'll use the term mandatory. We know public firms have mandatory balance sheet, income statement, et cetera. Do the private firms here, do you know to what extent they have made, the standard financial statement disclosures? The reason I'm asking you is, assume you have a private firm that's published its financial statements voluntarily, okay? The impact of the news item, like you did for IKEA before, the impact of that news item is going to be very different than if a comparable private firm has not made its financial statements public. So in one case, the disclosure is kind of against a background of all this financial statement information. In the other case, the disclosure has no background. So the impact and the meaning that the market interprets of that disclosure is going to be very different depending on what precedes it.
This is something that I haven't thought about. We haven't thought about that. You are talking about that what I can sense from your question is that you are saying, wait a minute, Feng, you have to compare apple to apple, and you cannot almost like when you assess the importance of private firm news disclosure, you have to almost like ensure or assess the existence of private firms financial statement reports there, right? So somehow I think I kind of get your sense here. I haven't thought about that, but can I just give you some thoughts or some efforts we are trying to we are doing right now? One effort here we are really doing that. We haven't done that yet. We haven't finished that effort because it takes a lot of time and compile that. We are actually compiling the all available financial reports from private firms. This is something missing here. You are going to see in a moment. We haven't actually looked at the element yet, and this is so in that aspect in that regard, I think your question is very good. I think you somehow actually asked a question, something we are trying, we haven't done yet, but we are trying to fix yet. In hopefully in a few weeks. This is something that, namely, we have to control for the private firms' financial reports.
Yeah,
okay, and hopefully that makes somehow make this kind of apple to apple kind of comparison, because you said you cannot just compare private firm without any financial reports and then with public firms with with the mandated financial reports, right? That's kind of some sort of the question I heard, a concern I heard from you.
Yeah, I mean, it's going to be, look, when people look at public firm disclosure,
right,
voluntary disclosure, every public firm has a mandated set of financial statements, things like that they must do. So you're taking the voluntary disclosure and putting it on the same, if you will, playing field, okay, the same base. But then when you look at private firms, the base may be different, okay, because not all of them have, in fact, the odds are the great majority of them have not made their financial statements public, okay? So it's yeah, you want to call it apples and apples, that's a good way to think about it. Got to make sure you have a level playing field.
Right, right.
It's just, again, another thing you should think about.
Very good, very good. All right. So thank you, Paul. And so this is wonderful. And guys, please ask me questions. And this is something that this is something that we benefit a lot from the discussion. Okay, and please ask even any random question, because there are some certain things we haven't thought about. As obviously, the question that the, asked by Paul could be very helpful to our revision and continued effort in the project. Okay, so let me just summarize this from this slide. So we just give you a sense, a flavor of the percentage of a private firm news disclosure in specific industries. And I also give you roughly the percentage, around 13 to 14%, okay, in a typical industry on average, okay? So news disclosure from private firms account for about 13 to 14% in a typical industry, okay? Which means what? Which means, yes, I mean, we have to admit it. Public firm news disclosure is still like a, still like a dominant in a sense, 86, 87% in a sense. Of course, because public firms, they have capital market pressure, and they have, they are more active in terms of trading. They have to serve, they have to meet the, demand from different stakeholders in a sense, right? But nonetheless, our key point here is that, guys, please do not ignore the disclosure and news information from private firms. And that's kind of the driving force, the key message we try to deliver to you. All right. Now we want to get to the second part, which is the literature part here. Sorry, I'm trying to see the timing here. I just realized, we are moving around fairly nicely. But guys, please ask questions. So second part here is about literature here. The literature, we want to look at two streams of literature, okay? The first stream of literature is about private firms, okay? There are quite a few papers. I mean, Paul, David, they are very interesting about the private firms, right? So there are a lot of papers about, private firms. For example, I just want to give you some, brief review of private firm papers. For example, Bird et al. 2019 paper is about private firms and loan financing cost. Gao et al. Talks about the innovation activities for private firms. Gao et al. 2017 is about the CEO turnover performance sensitivity of private firms. Why do they want to look at CEO turnover performance sensitivities? Because the argument, I think this is a key argument from researchers, is that, well, private firms, maybe they don't suffer as much of an agency kind of risk or agency cost, okay? So maybe that the turnover performance sensitivities for among the private firm CEOs could be higher, okay? Another paper, Oscar et al. 2015, they talk about private firms investment sensitivities, okay? And Gao et al. 2013 talks about private firms cash holding. All right. And another important stream of literature we want to look at is about the spillover, or if you look at the title of our paper, is about externality. To me, guys, maybe you can correct me, but to me, they are about the same thing here, okay? Spillover, externality, they are pretty much the same thing. So information spillover, AKA externality, okay? So this information spillover could be from public firms to public firms, okay? Could be from public firm to private firms, okay? So let me review the first set of papers from public firms to other public firms. So essentially, we assume that the certain information could be in the earnings information, or could be in the investment information, whatever information from the could be a bellwether firms from of public firms, and that information provides signal to other public firms, so-called public peer firms in the same industry. Okay. For example, the first paper by Denef and mentioned 2009. It talks about the public peer firms and learn from the restatement of a certain of the firms in the same industry, and they just adjust their corporate investment decisions. And that paper is very interesting because that paper talks about both the positive and negative information spillover. So sometimes the point here is that sometimes don't think about the spillover is always good. There's not always a positive spillover effect. Sometimes spillover could be negative. So that's one of the earlier papers that talks about the negative spillover, meaning that sometimes the peer firms may learn something wrong signal or take the wrong signal from the from firms from the same industry. Betty et al. 2013 talks about the spillover of fraudulent financial reporting, and I think this is a similar nature, but they talk about the investment efficiency. Sharaf et al. 2017 talks about information environment, of the peer firms, in terms of cost capital of other peer firms. Okay, Lee 2016 talks about I think this somehow the Donev mentioned, Betty and Lee, the papers are kind of, they follow similar story, basically saying that if a firm has a poor financial reporting quality, that somehow will provide a wrong signal to peer firms in the same industry. That will affect the investment decision. It will affect some other operating decisions as well. All right, Chow and Muslu, and this is a very recent paper, 2021, talks about the once again the investment and inventory decision based on the MD&A disclosure of the peer firms. Okay, so those are both from the public firms to other public firms in the same industry. So that's roughly the first set of papers. The second set of papers are about public firms. Actually, information may spill over, may get transferred to private firms. Okay, so that's Badester et al. 2019 talks about the private firm investment, and that investment could get affected. The decision will be affected by public peer firms' misvaluation. So public peer firms, misevaluation, meaning that sometimes the stock price of public peer firms could get overvalued or undervalued. That somehow they will affect the private firms' investment decision, because private firms pick on the signal from that valuation of public peer firms, right? Then sometimes the signal could be wrong signal. Okay. So that's still the public firms information. It could be the earnings information. It could be this valuation information, price information, and that gets transferred into the private firms, decision making. Yes, go ahead.
Paul, you have a question? You can open your mic.
Go ahead.
One second. The literature review is very interesting, but it's about 45 minutes in the seminar. I have to admit, I have no idea what you're doing and what your research question is and what your test method. Could you maybe get to that? Because that's,
yes,
that's clearly...
ironically, I get to that in the next slide. Yes, but
okay.
This is an early paper. Sometimes, it's, we haven't optimized the presentations flow yet.
I want to know what, I'm sure I speak for everybody. We want to know what you're doing.
Oh, okay. Enough said. In fact, I'm not worried about, am I able to do 1 hour, 30 minutes? Okay, I will get there. Okay, so let me finish the last line here. The last one is Badester 2013 here, talking about the externality of public firm presence to private firms' investment decision. Once again, from public firms to private firms. And so now also Paul said, hey, you haven't shown me that what you are trying to do yet. What? It's 12:43 already, right? All right. Now what we are going to do is now we are saying, well, if you look at this literature review, something public to public, public to private, and we say, well, maybe there's some sort of externality from private to public, right? So it's and as I mentioned, I think the conventional wisdom was that, private firms, they wouldn't generate too much information flow. There's not much, they don't have much incentive. Maybe they are too afraid, so they don't generate, create too much information. But as I showed you a moment ago, right, in the background, in the statistics, it's not true, actually. There's a fairly significant, of course, if you call 10-15% as a significant, there's a fairly significant information flow from the private firm side. okay? So what we are trying to say here is that private firm news disclosure may contain certain important information, as I mentioned, right? Maybe firm's prospects, maybe firm's strategy, maybe the industry outlook, because maybe if you look at some bellwether firms, public firms in the industry, maybe you may not see the whole picture. Maybe you want to look at maybe smaller private firms in the industry, maybe to get the complete picture, right? And so this kind of information will perhaps reduce the industry level uncertainty there, right? And so our argument here is that, you know, private peer firms and managers, maybe they utilize the information from private firms, they make a more accurate assessment about the expected future cash flows. And by doing this, they will increase peer firms, public peer firms' investment sensitivities to their growth opportunities, okay? So the first hypothesis is that if we have more information from private firms, that we will expect a higher investment sensitivity from public firms, okay? So in fact, here you see that here, we talk about so many about private firms, but in fact, we focus more like from public firms. So it's like, oh, we might expect some beneficial, you know, spill over from private firm disclosure. That's the first hypothesis. The second hypothesis, we look at the positive and negative news and you know, sentiment there, right? From the sentiment, we did you know, textual analysis. So if the sentiment disclosure conveyed by private firms will you know, if a positive, you know, it will increase the news investment sensitivity, but even the negative one will also increase investment sensitivity of public peer firms. Let me emphasize, we now, go ahead.
Professor Samir?
Good paper, Feng. You know, I have you know, through which channel? I mean, we're talking about two different, we're talking an elephant compared to a mice, right? Public firm, the disclosure requirement, the disclosure infrastructure, the disclosure environment, the audit industry is totally different from the private firm. So, I mean, your first hypothesis, through which channel, like how a disclosure made by a small private firm is going to make it to the public firm, knowing that these two are two different leagues, you know?
Right.
So, I mean, I think I would suggest that in the hypothesis development, you kind of elaborate more on the channels through which like a disclosure is going to have more an impact on the investment sensitivity, you know?
Right, I agree, Samir, I agree. Now, I don't have, you know, specific, you know, answers for you at the moment. Having said that, I do realize that maybe we have a few cross-sectional results. Maybe the results will help a little bit on the channels element aspect. Okay, so we'll get there. But once again, I think this is something that if you are a reviewer, this is a tough review question for us to answer. I have to admit that. Okay, so I will get there again when we talk about cross-sectional.
David,
yeah, go ahead.
Feng, can you come back to the previous slide?
Yes.
My question is similar to Samir. So here, when you say private firm convey information, so you are talking about credible information.
Yeah.
If the firm is small, I don't think people would pay a lot of attention on it. But if firm is big private firm, like the example you gave it to us, IKEA, I guess those information would be very credible.
Right.
But my next question is, here you really talk about the information content or the information quality.
Well, here, so the first one, very good question. But by the way, let me. So you are concerned about the size here, still the you know, the size of the private firms, and you are making a conjecture saying that, and which is I think most people will agree with you. The you know, if the firm is private firms tend to be small, they are not meaningful. You know, they are not making meaningful disclosure. Even they make a disclosure, people tend to dismiss their disclosure. Okay?
Attention, not much
Yeah.
attention.
Yeah, attention. Okay. But I think that to answer your not the question, I think this is a good observation. But I think that you want me to get into the H1, H2 a little bit more specifically. Let me answer you. H1 is more about the number. Remember, I give you the percentage of the private firm news disclosure, in terms of percentage, right? So the first one is more like we are saying that it's not about quality, it's just like almost like a quantity. Like
Okay,
the
volume.
more you make a disclosure, so this is
Okay.
more like so you ask a good question. So help me to clarify things, right?
Yes,
This is more
okay,
like a quantity, the quantity
Okay.
element. The second one is, once again, I'm sorry, it's not quality as well. H2 is not quality as well. It's about sentiment. But so we look at the contents, but we cannot argue that it's a good quality content or high or low quality contents there.
Yeah,
Having
but
said that, David, yes, go ahead.
I think you make the assumption the quality is good.
Well, in
Yeah,
fact, in the end, I'm going to present you some preliminary results that sometimes the quality may not be good, okay?
Okay.
But in general, the sense here is that, we are making assumption, or we are not making any assumption, but I think the hidden assumption is almost like, with the balance of this large amount of information, right? And information is generally beneficial. I think that's the sense here. So even though that it's almost like but we need to think more carefully here. But I think the sense here we are almost telling ourselves, we are saying, well, with the it's almost like a large number theorem, right? In a sense, with the large amount of information, maybe that correct information or good information, high quality information will wash off the bad information in a sense, okay? But once again, we haven't thought too much about it. You are making very good point here. We do have some results in the end by saying that, well, private firms they may make some biased information. Okay, that's
Okay.
kind of almost going back to the quality element here, right?
Okay.
But so far, yes, we are almost saying that, they are always making some good, some beneficial information, or the more information they make, the more beneficial,
Okay.
if you take it as a whole here, okay?
Samir?
Let me
Samir?
go back to,
You have a question, Samir?
yes, Samir.
Yeah.
Go ahead.
H1 is suggesting that there is a kind of information transfer between private and public firm, right?
Yeah.
Can you, or is there even anecdotic evidence that, for example, cash flow of private firm within the same industry are correlated to those public firms? So, because, without showing like these private and public are somehow interconnected, it's very hard to kind of make the prediction that a quantity of disclosure that may be done just for impression management purpose, just for a public relation story, will make an impact on the investment,
Samir,
So,
that's a great point. Yeah, go ahead. Continue, please. If you
if I were you, I think I will either do a kind of anecdotic evidence about a public disclosure made by IKEA that made an impact on a public firm on the same industry. So at least we show, like, economically speaking, there is some phenomena going on the ground, and we want to test whether that's the case on a big scale or not.
Right. Samir, I think this is you made a wonderful point here, but I think that to address your point here, you suggest that one is that finding, and we haven't done it yet, okay? And this obviously is some sort of gap in our research here, okay? You said we need to find one or two anecdotal examples, evidence showing that public firms actually they do react to the disclosure from private firms. Okay, maybe from some bad weather like big private firms. And that's what I heard from you. That's point one. But I think some, a moment ago, you also mentioned one thing, and this is something we probably need to do as well. I'm not sure yet. You are saying we probably need to show as not only any notable evidence side, but also from that larger data side. You know, the public firms actually they do care about. I think this is the, yeah, they do care about the private firms' disclosure because, as you said, this is a you know mice versus elephant. The rice is like it's like a could be very different kind of magnitude there, right? So in a sense, you are saying that you guys need to first establish credibility here, right? This is what I heard from you. So I think maybe some in addition to anecdotal evidence, we need to have some sort of you know, additional kind of results showing that yes, for example, public firms investment, maybe some operating decisions, they are affected by disclosure from private firms, right? To establish this kind of baseline, you know, result, saying that yes, they do care. Then then you can see the information transfer. I see.
Absolutely.
Wonderful. Okay. So I think that those are very, very helpful comments. Now let me Paul complained. So this is almost like a rehash of what we just mentioned. So Paul, because we barely heard your you know, research question yet. Now it's the time probably like 12:53 or 55 already. So once again rehashing here. So first we want to look at externality. Are there any externalities, right, from private firm disclosure to public firm's investment decision? And the second point here, we look at the content element. How does this detailed content, because the first part is a, you know, prompt by David, right? David say, hey, it's a quality or quantity or whatever. So first part is more like quantity. The second question here is about detailed content here, right? How does the detailed content of a private firm news disclosure affect this externality? Also, okay, so those are the two main research questions. I'm going to summarize the results given the potential time constraint here. So the first result here is about externality. We do find public firms investment, you know, is more sensitive to investment opportunities in industries with more private firm disclosure. And then we also look at the some cross-sectional results, which I'm going to mention in a moment. The second one is about we find both positive and negative news disclosure from the private firms will increase the investment sensitivities of public firms. And we also look at the news type. Like, yes, go ahead.
Question from Greg.
Yeah, hi. So this is Apoorv. Hi, Mohammed. I believe you're referring to me. Okay. Hi, Fang. I'm sorry. My question is actually just related to your research question, and I was hoping that you could get more in terms of the actual measurement. So, my question is sort of piggybacking on Sameer's earlier concerns regarding the exact information and the precise information that's conveyed by these private firms to the market at large that's useful for these public firms' investment decisions. So when we talk about these news disclosures, are the focus of these news disclosures exclusively those private firms? Because often these news articles mention several other firms.
Can I get to that element, you know, in a moment? Because in a moment I'm going to show you quickly show you the results. And I think, as you said, you know, your question is more about the specific measure there, right? We are taking, but just to answer your question quickly, we are taking a scale. We are scaling the news disclosure made by private firms across, you know, over the news disclosure made by all firms in the same industry, in a sense. Okay, okay. Did I more or less answer your first question?
So when you say that news disclosure was made by private firms, so they initiated that news disclosure. So it was like a press release or something.
Yes, that's right. Yes, they do.
Okay.
Yes.
Okay.
Yeah. Yeah. Okay. So, but please go, when I mention some certain, measures, and you can just keep asking questions. This is something that we feel very, very helpful, by answering questions, by clarifying certain points we make, and by helping us to fill the gaps we still have and this paper, right? Okay.
Sure, thank you.
Yeah. Thank you. I'm trying to pronounce your name, but approve.
Yeah, this is Apur. Yeah, you're almost there.
Sorry. Thank you, approve. So the second element is about it. So we talk about externality. We also talk about content here. The content here, we also differentiate between the financing related, investing related, but there are some other, news types. So we look at the two most important, big news types, and so we find that they more or less they are able to generate externalities to public funds investment. The third one is I think this is something that we are trying to work on. We haven't finished yet, but this is we call it negative externality. We do, and I think I remember that was a David's question, right? Quality, right? In a sense, we find, but we don't find we are very careful in this part yet. We are not saying the firms deliberately, private firms deliberately give misleading information or anything. Although that, so at the moment I call it bias disclosure, because sometimes maybe firms could be very conservative. So when they make a disclosure, maybe they just oppose a conservative tone on that, right? So if they have a negative, if they have a bias disclosure, then the impact will be there will be a negative externality in the sense that it doesn't facilitate the investment sensitivity from the public firms. Instead, it reduces investment sensitivity among the public firms. Okay, so that's the something I want to hopefully I will show you in a moment. And so we are going fairly smooth. Time now is 1:02. I really appreciate this. Is very helpful actually. So allow me to move to the third part. It's about we already talked about data and methodology here. So data here once again we already mentioned is from CapitalIQ for both the public and private firms. But we have a news data source that's coming from the CapitalIQ Key Developments database here. They provide 100 different key development types. And now I want to go back to the question that initially asked by Paul at the beginning of today's presentation. I think I already mentioned a little bit, but let me give you the official summary here, right? Why do CapitalIQ have financial information about private firms? Okay. And so they are really, this goes back to the two different requirements from SEC, right? One thing I think everyone knows is that, when we are talking about requirement, by the way, in the US, in Europe, in other countries, the requirement could be very different, okay? In the US, SEC requires, firms to file public financial reports if the firm actually make public debt offerings, right? In addition to public, equity offerings. Okay, so that's the first one. The second requirement is that even the firm does not file any public debt, doesn't offer public debt, it must file a so-called Exchange Act registration statement if it has more than $10 million in total assets and more than 500 shareholders, common shareholders. Okay, so that's the end. This is not all. So because there are a lot of private firms have more than 10 million total assets, right? But they don't need to file, financial information. But if they have more than 500 common shareholders plus 10 million total assets, then they do need to file public financial reports. Okay, so those are kind of requirements, and that's how, in our understanding, that CapitalIQ, amass and compile the financial information from private firms, and that's why, as I mentioned, the CapitalIQ data consist of larger sized private firms instead of smaller sized financial, relatively speaking, smaller sized financial private firms from another data source called Sageworks. All right. Now let me move to research design. And this is our main design here, research design here. On the left-hand side, we have investment. Okay, so when we talk about investment, it's individual public firms investment decision investment. Okay, and what we are saying here is that investment is affected by the on the right-hand side, if you look at investment on the left-hand side, investment is affected by two elements here, right? One is the firm's, its own firm's investment growth opportunities. Now, investment opportunities in this paper, we use a Tobin's Q, okay? Tobin's Q. And then also another element is what is the key, the test variable, which is called the private firms and news presence, right? And remember, this is an industry level measure, not a firm specific measure. So we are saying that the investment decision by a public firm will be affected by its own investment opportunity and somehow modified or moderated by the private firm news disclosure in that industry. Okay, that's the key idea. So the key test variable is beta 3 here. The coefficient is beta 3. The key test variable is this interaction term, investment opportunity times private firm news presence there, right? Okay, so that's kind of the key idea. So we are looking at we want to look at the coefficient beta 3 because it captures the incremental benefit, right, of the private firm news disclosure, okay, to this investment investment sensitivity. All right. So if you look at the main result here, we see that the coefficient of this interaction term. Yes, go ahead. Go ahead.
Question from Phillips.
Okay.
Hi, Feng. It's Luke from Queens.
Hi, Luke.
Hi. Just had a question here, and I'm sorry if you already covered this. We know that private firms are smaller on average, although obviously there's some heterogeneity within private firms in terms of size. But for your beta 3 coefficient, if you replaced private firms with smaller public firms, would you expect a different result?
Let me try to understand your question first. Are you saying that I try to replace this private firm because this regression is about public firms. Investment is a public firms. Investment opportunity is a public firms, right? But the private firm setting from here, right? So this is a private news disclosure. Are you saying that I replace a private firm news presence with smaller public firms and news disclosure? And is that what I'm trying to, what I heard from you?
Yes, I'm just trying to get at, what exactly are you expecting to be different if you look at private firms versus smaller public firms making disclosure? Right. Thanks.
We haven't thought about that aspect yet, but I think one thing this is something that we already did, but I haven't have a chance to present the result. We now I know that this is not 100% answer your question, but now what we add is one big important thing is that we also control for public disclosure. Okay. So let me. I know that this is just a scribbling here. I'm sorry. So what we add, we haven't done that in our current set of results. But I already have the results. The new result just prepared a couple of days ago. The new results was about we try to control for public firms. So we have a private firm news disclosure. In the meantime, we also control for public firm news disclosure. Now, to get back to your question, you are saying that you just you are just conjecture maybe in this private firm news disclosure although it's kind of informative, that informativeness could be similar to the informativeness of a smaller, much smaller public firms news disclosure. This is what I take from you, right? And but we try to I did not even realize your question, but what we did a few days ago was that we added a public firm news disclosure. And when we say public firm news disclosure, we include all big and small public news disclosure. Luke, did you hear what I said? Did you get what the sense of what I said?
Yes, I hear.
Yeah. So that did not exactly address your question, but somehow I think that somehow mitigates your concern. You are saying that, oh, maybe there are some other the information informativeness from some other pool of public firms, right? Which I will agree. So we just control for all public firms, right? Okay. So I hope that somehow more or less address your question. Okay.
That's good. Thank you.
Great. Thanks, Luke. When you say Queen's, are you talking about the Queen's University in Canada?
Yeah, that's right.
Oh, okay.
You came to present a few years ago.
Oh, okay. Thank you for coming.
Yeah,
All right.
Another
Go
question
ahead.
from Abu.
Yeah. Hi, Feng. Hi. So I just have another clarification question regarding the research design. So this private firm presence, as I understand, measures the relative disclosure by private firm relative to the entire industry, right? Both other private firms as well as all the public firms. So I'm just wondering, like the effect that you observe here, this relationship, could it be in addition to public firms reacting to the disclosure, could they be reacting to the subject of the disclosure itself? For instance, you mentioned earlier that the private firms could be disclosing about M&A, could be disclosing about their investments or upcoming products and things like that. So the public firms are responding not to the disclosure, but to those real decisions of the private firms and the happenings in the industry per se.
Right. Approve. That's a good question. But I mean, if you don't mind, allow me to just proceed. And literally in a moment, I'm going to show you some results, and then at that time you are going to ask the question, because I'm going to show you some sort of news types and the results, and that somehow kind of adjust or maybe partly answer your question. What do you think? Okay.
Yeah.
Okay. So I promise you, I think I will get some of the results will address your question. Okay. So the first one is that let me proceed. So the first result is about externality. So we established that the positive, coefficient on this interaction term, saying that where this is actually confirms the first hypothesis, basically saying that increased news disclosure from private firms in the same industry will increase the investment sensitivity to the firms its own growth opportunities. Okay. The second one that this is more like a robustness check. We replace Tobin's Q with the sales goals, because there's a common concern from the literature saying that are you talking about firms maybe they learn from the private firm disclosure, and maybe they learn from their own stock price, right? Because Tobin Q is really, it consists of market value. Okay, so it's maybe it makes the inference maybe unclear in a sense. Okay, so we need to exclude so-called the stock price feedback effect. So that's why. Okay, so results will be the same when we replace Tobin's Q with the sales goals. Another one is also our attempt to present you with to exclude or to exclude the alternative explanation, namely the stock price feedback effect. So we use the investment efficiency measure when we calculate investment efficiency measure. So we essentially calculate the expected investment from a traditional investment model. So this investment, so-called investment inefficiency, captures the residual. Okay, it's a residual. Okay, sorry, I'm trying to write here. It's a residual. the residual captures the because residual means a deviation from expected investment level. Okay, so the dependent variable on the left-hand side is the residual of the, which means the deviation from expected investment. Okay, so that's why we call it investment inefficiency. So what this one says is that the negative coefficient is expected. It says that the additional private firm disclosure will reduce investment inefficiency. Okay, and then we also separate into the overinvestment and versus underinvestment, because the residual, you have a positive number, you could have a negative number. If you have a positive number, that means that suggests overinvestment. If you have a negative number, that means underinvestment, right? So in on both sides, we are able to find that, the consistent results. We are saying that, well, additional news disclosure from private firms will help to reduce both overinvestment and underinvestment. So I think this is actually very interesting results. And I know that a lot of finance people, they don't like this investment efficiency measures, but I think accounting people, I think we feel that this provides a cleaner and more robust, inference from that, the beneficial role played by this private firm news disclosure. Now I think I'm trying to answer somehow get to the detail here, trying to answer a couple of questions from the audience. So first one is that we want to look at the sentiment there, right? The sentiment, what we are trying to say that it doesn't really matter the sentiment, either the both positive sentiment or the negative sentiment, okay? Both the positive and negative sentiment will increase the news, will increase investment sensitivity. Okay, and then but if you look at the investment efficiency side, I think it's interesting. The result is interesting. For example, we find that the negative sentiment will reduce investment overinvestment in general. I think this is consistent. But the positive sentiment has nothing, has no effect. Okay. On the other hand, we find the positive sentiment, news disclosure will help reduce underinvestment for sure, but the negative sentiment has no impact. So in general, here, as I think David said, I think we are almost like taking a stand here. We're saying, wow, this private firm news disclosure in general played a very beneficial role, right? In terms of this all positive information spill over here so far. Okay, now we get to the question. I think Approve asked a question a moment ago saying, hey, the news type, it could be the different news type. And I think he specifically mentioned M&A. So here we actually, classify the types. Not, by the way, this is not all the news. The news types could be a lot more. We are just, we classify, a few news types, what we believe to be most important news information. Okay, so we have a financing related press release, investing related press release here. So financing include the financing and also investor relation. And I complained to my colleagues, I said, why do you call it investor relation? But my co-authors told me that, oh, this just came from the CapitalIQ, their classification, their naming there, right? But if you look at the investor relation, it contains a lot of a financing element like a or transaction, right? Dividend, stock buyback, etc., right? So that the investor relation here, it sounds a little bit misnomer here, right? To me, okay. And then the other one is about investing related, so product and service and M&A. Okay, so I just want to quickly present you the results here. What we find is that the financing, investing relation, and also M&A, more or less the results are there. We find those all the information here, most information from the three subtypes of news disclosure will help facilitate the investment sensitivity of public firms. But we do not find the results here, okay, on the public, on the product related disclosure there. And my conjecture is about what? It's about the proprietary cost there, okay? Because maybe firms who be private firms who hesitate to make substantial or reveal their product related news or this or make that kind of related disclosure.
Bro,
Okay, yeah, go ahead.
Question, bro, from above, you can ask.
Go
Hey,
ahead.
Feng. Hi, it's me again. Thank you so much. It's very helpful, like this breaking down by the different news type. I think it could be helpful. Like I see you don't find results for product related news type, and perhaps it could be helpful to sort of increase the lead lag relationship, because let's say the private firms made some disclosure related to the product. As you said, there could be proprietary concerns, but even if those disclosures were informative, for other public firms to respond, to take actions in response to those disclosures, it could take time to manifest, right?
Okay.
The investment is a bit sticky. So maybe if you
Okay.
increase the time horizon, maybe there are
Okay.
things that don't manifest
Okay.
immediately in the next year.
That's a good thought, which we haven't thought about. The point here made by Approve was that it may take some time for that news information to take effect. I heard you, but what we try to spin the line system of the effect here was that this kind of information is more sensitive. There's a lot of proprietary cost involved, and that's why that firms, private firms, they hesitate to make that kind of that substantial disclosure on that element. And as a result, that kind of disclosure doesn't help a public firm to make better investment decisions. So that's kind of the spinning here. But of course, there could be other things. For example, Approve, based on Approve, suggestion, we probably could just add one robustness check to see that if we add into that T-2 and see that if the results are still there. Okay, I only have probably like
a question from Samir.
Yes, go ahead.
Dear Professor Samir, you can open your mic and ask your question.
Great paper, Feng. I mean, I really like it. There is a paper that looked at shareholder governance, bondholder governance, and risk taking. And these papers look at investment from good investment versus not that good investment. So CapEx, they take them as good investment because they provide future economic benefit. R&D expense in the income statement, they take them as poor investment, right? So I'm wondering if your H1 should hold, and if private firms are providing some externality to public, I'm going to see like more CapEx rather than R&D expense. I can send you the paper, I think it's really related to this.
Okay, yeah, I think we haven't, I don't know the paper, but I mean, Samir will be really helpful. Even you give me like a citation of the paper, we can certainly, that would be really helpful. But having said that, you just remind me that I want to emphasize the total investment has a lot of R&D, like include R&D there, right? CapEx is capital expenditure, right? So, but total investment include R&D. So that's why we have a parallel results, across all tables. Okay.
No, my point is to disaggregate that total investment into CapEx and R&D expense. Okay. You're going to see in this paper, they really provide good theory of how CapEx and R&D are two different forms of kind of, they call it risk taking, but for your paper here, you can call it investment,
Right.
I'll send you this paper. I think it's very relevant to your talk.
Okay, great. Yeah. I see the point. I will do. Okay. So I think we probably have to tease our R&D separately and so on. That's what
absolutely,
from Samir. Great. Now I just given the time constraint, I only have 6 minutes, and this is so far it's already much more beneficial than what I thought, actually. You know, I be honest with you guys, right? One thing I always afraid is not like by questions or question being asked, you know, but by like not questions. Thank you, guys. Now, so I just quickly summarize because this is just a cross-sectional results. The first thing is that we want to look at that. We're saying that we want to look at how similar private firms and public peers are in that product market, in that industry. Okay, so there is we take some sort of a product market similarity. Okay, so the idea is that if they are more similar, okay, private firms and public firms, they are more similar in that industry, then the information conveyed from private firms will be more helpful, right? So we find that result. The second one we find is that if the private firms are more important, what do we mean by more important? Meaning in terms of size, they are bigger, right? They are like for example, they are dominant, you know, dominant not from one particular private firm, but from that as aggregate together. Like, for example, private firms are taking, as I just give you a few numbers, for example, 80% of total assets in that industry, for example, right? If they're more important, maybe the effect will be more important, right? That then we just maybe we will say, oh, we cannot just easily dismiss the voice from the private firms. I think that's common sense. Once again, I think we find a similar result, consistent results. The third one we want to look at is the industry level kind of information. If more analysts already cover the industry, then once again in the aggregate sense, then maybe there's not much industry uncertainty to start with. Maybe if there's not much industry information to start with, maybe we will find stronger results, or maybe we find weaker results. We don't know yet. So this is actually something that we get comments saying both ways. But here we say, well, maybe we find stronger results. So we find the stronger results here. Okay. So this one actually we can argue that more analysts following, we can argue both ways. Okay, we can find stronger effect or maybe weaker effect. But here we're saying maybe we could find a stronger effect here. So that's what we find. Okay. Now, I think this is one thing that the good part to almost like complete my Samir. Sorry, not Samir. Mohammed, you have to remind me if my time is up, because I'm trying to see the timing here. Okay, but this is a wonderful part. It's the preliminary result. We are asking, is the externality is always a positive? There might be negative externality. That's the question there, right? That's, I think, that what David asked about quality, disclosure quality. We didn't really look at disclosure quality, but we want to look at so we call it biased disclosure. I wouldn't use mislead because we don't know if they mislead, but we want to see one element here. We want to see that here we capture the firms, some firms in the industry, private firms in the industry, they tend to make a conservative disclosure, like a negative disclosure, while their performance is actually fairly good. Okay, so that we want to capture that aspect. So if you look at the left-hand side here, we are saying that if they make this kind of biased disclosure in terms of what? In terms of they are conservative. Some private firms could be very conservative, right? They make negative disclosure, but while their performance is above the industry average, okay? And what we find? Well, we find that results are somehow, well, negative, but not significant, okay? So that's the left-hand side. And then we turn to the right-hand side. The right-hand side results are much more significant. What do we do? Well, we look at the dominant private firms. So we are saying that, but you guys can, can help me, and maybe you have some other questions. What we are saying here is that if private firms, some certain private firms, they are not just a typical private firm, they are dominant, they are like a larger size than private firms. They make conservative statements, disclosure, while their performance are above industry average, okay? Then what do we find? We find that their negative, conservative disclosure somehow kind of misled or provide a negative impact on public firm, peer firms' investment sensitivities. So I hope I convey to you. So the left-hand side, right-hand side similar, but the difference is the right-hand side we only focus on dominant private firms in the industry. So in one sense is that we provide some preliminary findings saying that yes, there is an existence of negative externality. And number two, we say public firms, they are persuaded, they are swayed by the dominant private firms negative, or not misleading, biased disclosure. Okay, so that's kind of something I want to convey to you. We are still working on this aspect yet. Now I want to summarize because the time is pretty much up. So I want to summarize. So we find the conclusion. I think we already talked about conclusion about externality, about content, about potential negative externality, right? And the contribution here, we essentially provide two contributions. One is that, to the literature, because the literature, asks for the real economic consequence of a private firm's disclosure. So we kind of contribute to the private firm disclosure, side. Another string literature, as we mentioned, is about information spillover. So we actually add to that information spillover literature by documenting that both positive and negative externalities, okay, from the private firm disclosure. And thank you so much for your participation today.
Thank you very much, dear Professor Feng, for your contribution and your effort. It's really an excellent presentation. Thank you very much. Are there another question? If anyone have any questions, you can open your mic and ask. Thank you very much, dear Professor Feng. Thank you very much. And so all that remains for me is to say thank you everyone that joined us, and I thank you very much for taking the time out to present to us today, dear Professor Feng. It's been really appreciated. Thank you very much.
Thank you very much, Mohammed, and thank you everyone for asking questions and participating in my presentation today. Thank you.
Thank you very much, and I hope to see you soon in Egypt, dear Prof. You are very, very welcome.
Yeah, bye-bye.
Bye-bye.